Hello and welcome to today's Trading the US Open. My name's Tim and I'm one of the traders here at the live trade room. So what we'll be looking to do during this session is we'll be looking for high probability trading opportunities across some of the world's largest markets, from your foreign exchange to commodities and also the global indices. So it's very important for us that we have a multi-asset class view of these markets and we look to position ourselves accordingly. For those of you that are perhaps genuinely interested in learning how to trade these financial markets from a perspective of understanding, being consistent in the approach that you adopt, discipline with your capital, then certainly we can help you. Do please go to our website, thelivetraderoom.com, for more information, and we'd be happy to go through a wide range of products and services that may be very suitable for you, all at very low prices as well. So we've got our trade plan from last night. We're looking for those opportunities to play themselves out. We've had some big news events over the course of last night's. We had the FOMC last night, should I say? I'll go through that in just a moment, a little bit more detail, and we've just had the BOE. So without further ado, then let's get straight into it. And of course, the first thing we do when we trade financial markets is we be mindful of the news events that are likely to impact our trading decisions. So we bring this across then. It's now Thursday, the 18th of March. just during the Asian session in the early hours of the morning, we've had quite positive employment data coming out of the Australian dollar. As you can see, a significant uptick in the employment change number, and the unemployment rate taking a nice little move to the downside. So improvement with the Australian economy. It's just likely to be supportive of the Aussie dollar. So we'll be having a look at the Aussie dollar in just a moment. The big news of today is very much about the BOE. So we've had the MPC, we had the vote rate, and you can see it currently up on screen. So that came in as per expectations. So did the bank rate.
Bank Deputy Governor Floden says there are limits as to what asset purchases can achieve.
So I do have the squawk currently running. So you should you'll be hearing that in the background, and we'll get constant market updates live. So we've got the bank rate, kept rates at 0.1. Basically, as per expectations, there's been no shocks whatsoever, and it really wasn't. We weren't expecting any. But it is interesting to see what's happened to the pound. So we'll have a look at that in just a moment. And just briefly on last night's FOMC. So the Fed have maintained their quite dovish stance on these markets, very much expecting inflation to increase, and that have a knock-on impact on bond yields. So we can discuss it in a little bit more detail in just a little while once I've got the charts up. But what seems to be on the surface is whether the Fed are carrying, the credibility that they probably should get. Bearing in mind, we've got this very accommodative, fundamental monetary policy measures currently in place, low rates and excessive amounts of bond buying. So that's putting a bit of pressure. We've got the stimulus package. We've got conditions for actually significant inflation over the coming months. But the Fed have indicated that they're quite comfortable with an uptick, and they seem to be quite comfortable with equities pushing higher as well. So we've got this strange dynamic. Normally, we'd probably be in a interest rate increasing cycle. Bearing in mind the potential growth in the inflation story, but there seems to be a little bit of more capacity for a bit of an uptick in these bond yields. So interesting to see how credible the actual markets will effectively view those events last night. We're seeing some negative price action so far, and that's important to take on board. However, we're actively looking for those turnaround opportunities if we get them. So without further ado, let's go into these, and we'll have a look at the pound as well in just a moment. So I'll bring up our trading platform. Okay, I'll slide these across. Okay, straight off the bat, let's have a good look at what's happening in the US indices markets. So if I zoom in here, you can see what's happened. We've made a new all-time high before this market has now taken a rollover to the downside. One of the major reasons for that rollover to the downside, and I'll show you here, is the bond yield story. So if I get up the correct page, you can see where we're at, and I'll share this information with you. So it's just US 10-year Treasury details, and we can see that the rate. So the US government, this is a mechanism for the US government to, of course, take on some additional debt to pay for its.
We're just under 10 minutes away from the bottom of the hour, and the release of US data. We'll be leading with US initial jobless claims for the latest week, looking for an increase of 700,000, the range 670,000 up to 730,000.
Okay, we'll have a look at that now in just a second.
Looking for a slight pullback in continuing claims, seen at 4.07 million, 4.144 million last week. The range between 4 million and 4.2 million. Also get the Philly Fed Business Index for March. They're expecting a print of 23 against a prior 23.1. The range 15.5 up to 30. Going back to the jobless claims, quick preview here from TD Securities. They say the trend in claims does appear to be declining again, likely helped by an easing of COVID restrictions. They're looking for an increase though of 750,000 for the week of March 13th, thus put them above the market consensus. As they claims have been lifted in the last month by what appears to be a fraud-boosted surge in Ohio. All that said though, data remains volatile, and they're expecting the weekly reading to be up this week after 4 declines totaling 136,000. On the Philly Fed number, they're looking for an increase of 25. Again, that's above the consensus. They point out the Empire Manufacturing Index released earlier this week did surprise expectations to the upside.
Okay, so we might get a marginal
also
uptick in manufacturing.
At the bottom of the hour from the Bank of England Haldane, speaking at the 23rd Women in Banking in Finance Awards. No text expected from Haldane.
Okay, so we've got this data out shortly. So the bond markets is a vehicle for governments and corporates to borrow money at very, very low rates. Which one of the major concerns with that is it increases their debt profile. So they're taking on a lot more debt, and what we're kind of seeing is a very significant uptick. And I'm just sharing this. It's a yearly chart, and you can see since the beginning of this year we've seen. Let's take it to early January, should I say? So let's say we were around the 0.95% rate for a 10-year bond. So, the US government will be able to borrow money at that level of interest, which it's a great way to obviously take some capital on board. But look at what's happened since early January to this bond yield. So, demands for bonds have been decreasing really, and what's that? The net impact of that is that the fact that these bond yields have been increasing, and it's the rate of this increase that's really quite worrying and troublesome for these markets. So we've basically doubled. We're very close to doubling the percentage on the 10-year note, literally over the last 2.5 months.
Discussing a trade deal with the UK next week.
So that is quite significant. It's a considerable shift in these market dynamics. The Fed are quite comfortable with it. They would anticipate, we'd probably be getting to the 2, maybe even as high as the 2.5% level. So they're kind of building in an uptick in this 10-year bond yield. And that's building into their projections. The fundamental problem with this inflation story, so we've had the stimulus bill, 1.9 trillion. We've had a very accommodative central bank, low rates, massive bond buying program, and there's pent-up demand in the US economy. So they're expecting now, with the stimulus package, every American receiving $1,400. We're likely to see obviously an uptick in spending, and that's very much anticipated, and that's likely to lend itself to a stronger growth picture. And as a result, will there be an overheating of the economy, and will the Fed look to increase rates? And that's really what's important, because the debt burden increases and can be unsustainable for certain cohorts. That's the fundamental problem with it. So we're kind of caught in this sort of debt cycle, really. And what will be the fallout from the equity markets, from the bond markets, and for the economy at large once these interest rates start to increase? So therein lies some of the profound difficulties for the Fed. We will have to wait and see what the fallout and what the credibility of the Fed, how much credibility that we have, and one way we can do that is by looking at the price charts. So that is largely the reason for this rollover to the downside. So it's concerning pressures placed on On Fed expectations and the bond yields, we're seeing the equity markets actually take a bit of a negative roll to the downside. So that's what we're looking at currently, and we can see that play out, across the equity space. So we've got the S&P 500, we've got the Nasdaq. The only sort of, and what we're actually doing, we've actually got the conditions for some further buying. So we're not really looking for selling opportunities just yet.
Comments from the UK Health Minister, just pointing out we're currently experiencing or in the middle of some bumper weeks of supply of the vaccine. It says in April supply will be tighter than it is this month.
Okay, so as we look across these equity markets, clearly some selling creeping in across the board. So there's a little bit of nervousness. You would expect to see some capital perhaps come into your safe havens.
It's just over 3 minutes away from US data. US initial jobless claims seen at 700,000. Continuing claims seen at 4.07 million. And the Philly Fed Business Index for March seen at 23.
So just focusing on the US indices at the moment, we've got strong rollover price action as a result of this 10-year Treasury bond and the bond markets as a whole. We're seeing this uptick in yield, and it's creating a bit of a nervous environment for these markets. If you take wholly what Jerome Powell was saying last night and the whole approach from the Fed, they're actually very dovish and would be very supportive of equity markets pushing higher. So that's kind of the backdrop, except we're not seeing that just yet. So if there's money coming out of your equity markets, are they moving into gold? The answer so far is no, not really. They were moving. Are we seeing the yen strengthen slightly? Yes, but it's very, very marginal. We're seeing it strengthen against the euro somewhat, but we're still up at these very, very significant highs. The Swiss franc, you can see that the Swiss franc is not really benefiting from the rollover in the stock market.
The Minister reiterating the UK is on track to meet their vaccination targets.
So really we're left with the dollar. Are we seeing the dollar strengthen? So the answer to that so far is yes. The problem is, and we take on board the fundamentals and we want to position ourselves as best we possibly can. We do anticipate that there's scope for some dollar weakness and some equity strength. We're not seeing it right now, so we're slightly kind of offside really with our views and our directional bias. And this is one of the things that we teach our traders, is that try and have a directional bias.
We'll be leading with US initial jobless claims seen at 700,000.
And what that looks like is looking at a market like this and looking for opportunities to buy as opposed to opportunities to sell. And it puts us in a difficult position, because obviously we don't want to buy a selling candlestick. That's one of the rules that we look to adopt. But we want to see some kind of turnaround price action across the equity markets as a whole. And we can continue to sort of manage and just watch these markets and just see what they do. And when we look at a market like the 4-hour chart, for example, it's very easy to think it's kind of game over for this market, but it really isn't. If we take all this information into account.
10 seconds. Philly Fed out early. 51.8 for Philly Fed. 51.8 beats the 23 expected.
Okay, so we'll see how this reacts now. So
now waiting for claims.
So what we can see is this market continuing to make new highs and new lows? Well, at the moment, the answer is yes. So all this really is a pullback.
770,000 for initial claims, 770,000, continuing at 4.124 million. The prior initial claims revised up 725,000 from 712, and the prior continuing revised slightly lower, 4.142 million, 4.144 million. Philly Fed, as we said, beats at 51.8 versus 23 expected. The 6-month index up to 61.6 from 39.5. CapEx 35.9 from 25.2. Employment 30.1 from 25.3. And prices paid jumps to 75.9 from 54.4. New orders up as well, 50.9 from 23.4.
Okay, so that's not a good print really. It's probably up sort of 10% really on expectations. So it's unemployment claims have taken a bit of a significant move to the upside. A good market to just gauge would be the euro dollar. So we'll have a quick look at that. Just the point we're making is, if you look at the 4-hour chart, like, is it game over to the downside? If you look at the 1 hour, there's a couple of structural failures to the downside, and we're now technically below the low, so it does have that bearish bias to it. But if you look at it on the 4-hour, it's just a pullback off the highs. So will we find a bit of support at these areas when we start that next attack to the upside? That's what we're looking for. That's the trade that we're looking at. So we're not really interested in selling just yet. Now, if things change, we very well may do. We may change that bias, but for now, we're still looking for those buy trades, believe it or not, in markets like the S&P 500. And for the euro to actually show signs of turning around, where we're seeing a bit of dollar weakness. So right now we're seeing the dollar strength trade. Let's have a look and see that news event. See, was there any...
Some more vaccine news comments from the Dutch Health Agency reporting 2 cases of blood clots and low platelet count. This is following the AstraZeneca vaccine. Spokesman for UK Prime Minister Boris Johnson, meanwhile, says they remain confident about their supply of COVID vaccines.
Okay, that's interesting about AstraZeneca, because we should be finding out today about AstraZeneca, and we'll see how that goes. So this market is rolling over to the downside, the euro dollar. Just tidy this up a little bit. So we're in this little range. We're sort of trading above and below the monthly low. So you'd have to suggest there's a bit of short-term selling pressure creeping in. So let's have a look across the other dollar pairs and see where the opportunities lie. So we're talking about dollar strength. So we've got strength against the pound. In fact, just briefly on the pound, look at the rejection in the euro dollar. So we were really looking at this trade to the downside below the 85.43, and we got yet another rejection of that level. So we've been attempting to break through that level now for nearly 2 weeks, and we're failing to do so. And just to finish off, in terms of, is the pound weak or strong? It's weak across the board pretty much. So so we can take that from the BOE. And if I just pop this up on screen quickly. We've got the facility votes kept at 009, so that's very much in line with expectations, and the asset purchase facility again in line with expectations at 895 billion. Let's have a look at this ADP Canadian dollar figure. So nothing of any major concern. We'll just have a quick look at the dollar CAD quickly. So I do apologize. I'm just moving from market to market to just get, I suppose, a bit of an understanding. So we've got this dollar strength trade across the board, as you can see. So the dollar's strengthening against everything. And the equity markets are continuing to roll lower. So we can safely say we've got a risk-off market condition. like I was saying, that the problem we've got with that is it's counterintuitive. So is this a little bit of sort of profit taking at these levels? Is the market looking at what the Fed did last night and saying, we don't believe you, we think you'll have to raise rates prior to the end of 2023? They're saying they're going to keep rates unchanged through to the end of 2023. So for the next 2.5 years, are we likely to keep rates, at current record lows? The market very well may decide that the credibility or they don't necessarily believe the Fed. And if so, if that's the case, and traders and investors vote with their feet, and we're likely to see the equity markets roll over, and the dollar begin to strengthen. So there's the correlation. Sakalain, good to have you with us. Interesting question. Which is more profitable, intraday trading or long or short term investments? Very, very interesting question. If you asked me that question 2 years ago, a year and a half, let's say, I would have said without a shadow of a doubt, intraday trading is by far more profitable. With the nature of sort of these markets are quite jittery. They're quite difficult to trade, and we have found more success with our sort of medium and longer term trades in the last year and a half than we have done with our intraday trading. And I suppose trading bigger time frames and taking more of a medium term view just allows you to stay out of that sort of intraday chop. So very, very interesting question that. The performance of both short-term and more medium-term trading was pretty much neck and neck for about a year, and then over the last sort of 6 months, the longer-term time frame has kind of taken over a little bit. So it just shows you how challenging the intraday sort of market conditions can be, and it's something we speak about all the time. Intraday trading is definitely more difficult right now. Recently, I've been trading since 2008, so what's that, nearly 13 years, and we've got over 45 years experience between us here at the Live Trade Room. So we're definitely finding these challenging environments. We see a lot of that across the media. Some investment firms are absolutely flying, and others are really struggling. So there's the whole spectrum of performance out there, and it just depends on which side of the argument you want to sit. We've got a very accommodative central bank policy, monetary policy at record lows, interest rates, bond buying. Really, the central banks are doing everything they can to put a floor under these systems, but what it's creating is bubble type environments. Now, to say that the US equities are in a bubble is an understatement, and it's been like that for 4 years. So this is the monthly time frame, for example. So go back to 2008. We've just been in this incredible bull trend, as you can see. A couple of significant blips, but powering on to the upside at every possible occasion. Obviously, this is the 30-35% collapse due to COVID. So we kind of have to build all of these events into our projections when we trade. So really, there's monetary policy, there's fiscal packages. We've got the US government giving every American $1,400 check, basically, to go out and spend, and that's likely to add to this growth and inflation story or backdrop, and that creates a problem for these markets. And like I said, it depends whether you sit on the equities are going to continue to fly because we're in this growth story, or whether the bond yields will continue to take really significant and concerning worries to the upside, which forces the Fed to act, increase interest rates, and then everyone's debt repayments start to increase accordingly. And then what will be the fallout of that? Will we have some delinquencies and some foreclosures, and will certain companies that are already teetering on the edge, will they go over the edge? And what does that mean for unemployment? What does that mean for spending? So all of a sudden, a lot of and you're probably getting this from a whole variety of different sources, but there's an instability, which is it's likely to give us some fantastic opportunities when they do occur. But for some of, and if just look at the price action really in the last 3 days, so it's a little bit on the erratic side, isn't it? So Monday, no surprise, very little going on. We have the FOMC on Wednesday. So, sorry, that's Tuesday's candlestick, isn't it? So a little bit of positivity on Monday, indecision on Tuesday, indecision on Wednesday, and the build up to that event. And then today we take and make a new all-time high, and then the market rolls over to the downside. So like I said, we're actually looking for buying opportunities in these markets. So it's going to be a buy the dip type of trading strategy, because we think ultimately once this capital is spent in the real economy, it's likely to take on board more jobs, and if the Fed can make allowances for the yield curve, which they are doing, then there's every possibility that these markets can continue and are very likely to continue higher. So we want to position ourselves for those moves in the direction in which we think they are likely to move, which is to the upside. So this little bit of selling doesn't really bother us too much. We can look at the lower time frames and see at what point are we likely to be able to get into these trading opportunities. And you can see on the smaller term time frames, you can see the difficulty here. We've got structural failures to the downside already. I just use these intraday levels just to mark highs and lows. So once we made this high, we move sideways. Then we take a pullback, and this is your failure to make a new high. So then this trade here becomes a structural failure to the downside. We react around the monthly low just a little bit before falling through. We see a little pullback, and then we see the second structural failure to the downside. So when you see a series of lower highs and lower lows, it just implies that we're in this bit of rollover price action. Now we want to see if we can wait, and if we can be patient at this point. We want to see if we can see the opposite to the upside. So let's say we get a little bit of a pullback, we fail to make a new low, so we're actually making a higher low. So the opposite, the exact opposite of this, of that price action is what we're looking for now. So the market's pushed lower, we pull back, we fail to make a new low, and then we get this kind of W. It's M formation on the downside, it's a W formation on the upside, whatever you refer to it as. We refer to them as structural failures, higher and lower. So and what we would have to be with this one is actually above the monthly high, the 39.61. So maybe there's a bit of scope to just see how these markets have just been moving over the last hours. Are we going to find a little bit of support in this level, or are we going to break further lower? So we've got to manage price action at the moment. So we've got to make sure that we understand what's going on. So just a follow-up question there. How to predict whether the price will go up or down after resistance? Well, what we can do with that, if we understand support and resistance properly, and I think we've got time actually to talk about these things, because we can see that, and what I'm going to do is just see if we I'm just looking off screen as well. We've got other charts off screen, so I can see if there's something significant happening in some of these markets. Just to show you, the dollar, the US indices are actually ticking lower. So really, things are still stacking up at the moment for the dollar. The dollar indices to push lower and the US dollar to strengthen. So that's the opportunity right now, and we're waiting for those turnaround trades to start to kick in. So we might just need to be a little bit patient across these dollar pairs. So we'll keep an eye on the euro dollar. So yeah, so just going back to your question, how to predict whether the price will go up or down after resistance. Okay, what we might do is we might utilize, let me see if I can find a better example. Okay. So what I shall do is, let's look at this.
Further comments from Riksbank's floating that QE works both to keep markets working and to support economic activity. Well, now is not the time to dismantle policy measures.
Right, so just looking at the pound dollar, because it's easier to explain it on screen. You can see we're in a clearly defined bull trade, right? A trend to the upside. And it's just the process of looking for buying opportunities. So I'm sure we can all agree that this level roughly is a level of support. So it supports prices as markets push higher. So just S for support. And now we're currently up at this level. We're actually looking for some strength to come into the pound against the dollar. We're not really seeing it just yet, but when these prices break above this level and push higher, we can see there's a bit of room for this market to continue its upward momentum. And that's really how.
Further from UK Health Secretary Hancock, responding to EU threats on vaccine supply, all countries must respect contractual law, including the EU.
Okay, so it sounds like there is trouble brewing between the EU and the UK regarding these vaccine rollouts. So if we can all agree that this is a trend to the upside, but these are your support lines and these are your resistance lines. So again, the same thing applies. You'd be looking for selling opportunities. If you're a type of trader that sells resistance, then that's what you'd be looking to do. You'd be looking for these opportunities to get into these trades at these defined levels, and you need to just confirm or determine exactly what constitutes the buying opportunity. Rejection of the lows, rejection of the highs, structural failures higher and lower. So there's an awful lot, and in fact we've got a wealth of education actually over at the live trade room. We spend hours talking about this. We've got courses, we've got over 50 hours of content which goes through and teaches traders how to interpret support and resistance. Now it's a really good question, but how do we predict? Well, we need to see certain price behaviors around levels of support and resistance. So what I'd like to do is just zoom in on this little bit of price action here, just because it's consolidating and it's created support and resistance even within a predetermined uptrend. So we can zoom in a little bit more detail on this. Okay, sorry, I'm just having a bit of a problem there with my. So what we can all agree is that there's a strong level of resistance up at these levels. I just put a nice big R in there, and there's support in and around this level. We don't need to be too precise with these levels. So resistance and support pushes prices higher, and resistance pushes prices lower. And you can see, so we could mark that, and if you want to take a trade, there's a high probability trade below to this little low here for prices to actually continue further to the downside. And that's all we really do. We estimate probability. Saklan, apologies if I've mispronounced your name, but we assess probability of a significant outcome. So if we have a selling, like for example here, we've got indecision at a level of resistance, so we'd be looking very carefully for this. And once we get that, we can mark the low, and all we can do is say that there is a potential, that there's a probability that this market is likely to continue lower from that level. So it's constantly assessing probabilities for us. It's not like, yes, okay, it is predicting what's likely to happen. Yes, I'll agree on the wording. But really it's about the assessment of the probability. Is it a high probability trade? Is it a medium? Or is it actually a complete gamble of an opportunity? And how we can define that is by stacking the odds in our favor. Is it at a level of resistance? Do we have indecision at that level? Do we get sort of the reversal signals? Do we see structural failures to the downside? Do we see price and volume momentum pushing prices lower? And you're stacking up, or perhaps you have a moving average. Are you below a moving average? Are you below a monthly high or monthly low? Whatever the case may be. And all of a sudden, you do your analysis, and you end up with a little bit of a no-brainer. It's just assessing the probability of an outcome. And even when we get into that, because of the way we minimize our risk when we trade, we take the let's say when we trade the financial markets, we're very effective with our risk management. So we never put all our heart and soul in the next trade, which basically means we'll get into this trade based on the evidence that we identify, and we look to trade that market accordingly off that level of support and resistance. And we're just stacking the odds in our favor, and that's really what we do when we trade. And when we look at these markets, we don't need the next trade to be a winner, because trading doesn't really work like that. What we need to do is to have a certain percentage of winners over a long period of time, so over like 100 trades. Over a much longer period of time, if you get your percentages right and you get your positive risk reward right, you can stack the odds in your favor and you can make consistent returns. But you do need to make sure you control your risk. You don't get carried away with the emotions of trading markets. You try to keep your feet on the ground at all times. All of these things, it's a big melting pot of just understanding and awareness of these market conditions. And obviously, if you're as informed as you can be when you trade, you give yourself a very good opportunity. We like to know why we're trading the market in the direction in which we're trading it, and we're quite realistic with our potential returns and things like that. So all of these things formulate an approach to trading markets, as it does for your professional traders in your institutions, in your hedge funds, in the banks. They all adopt very disciplined approaches to trading. They try to understand what they do. Yes, they use technical indicators to get in and out. They have a whole variety of different methods that they use, perhaps automated trading bots as well. So all of that, again, that's their trading toolkit. Now, we don't have access as retail traders to a sophisticated and the huge expense that's involved as well in developing these systems. But we can understand the commitment of others. We can look at order flow and see where the capital is flowing. Is it flowing into equities? Is it flowing into safe havens? Is it flowing into gold? Is it flowing into the dollar? We can see where the flow of capital lies, and that allows us to almost predict ahead of time. So that's a long way of answering your question. So I wanted to start trading, but many people told me it's hard to earn, and it's a myth that someone can earn millions or billions from trading. What should you do? Has this stream gone offline? I think we're back. I'm not sure if that went offline there for a second or not. Okay, I think we're back, so that's fine. I'm not sure if I just lost you there for a couple of seconds. It's hard to earn, and it's a myth that someone can earn millions or billions from trading. What should you do? Firstly, my instinct is you will earn a percentage of your capital that you can trade with. If you can be disciplined enough to make perhaps small returns in the first year or two and genuinely learn how to trade these markets. There's a lot of educators and YouTube videos that will basically they'll use very clever marketing tactics to tell you how easy trading is and how much money you can make. I've yet to find one person that has been the reality for them. We as professional traders can spot holes in all of these videos and their approach and what they're telling people. A little bit of knowledge in this environment is a really, really dangerous thing. You actually need to entrench yourself. It's like taking up tennis or playing golf or snooker or whatever the case may be. You can get on a snooker table and you can hit balls around, but can you put them in the pockets, and can you do them in a game environment? And can you do it when the pressure's on? And that's where people fall apart. So it's well documented. 90% of traders lose money. Depending on which broker you're using, that might vary slightly. Might be 80%, 85%, 75%, whatever the case may be. But a large amount of traders lose money, but they do so for very, very specific reasons. There's a knowledge and understanding deficit. So they don't really know what they're doing. It's like going into a casino and just putting your money on black or red. It's guesswork. So avoid guessing. We stack the odds in our favor. We assess probability. We don't guess. We want to have an understanding of the market fundamentals. We want that behind us. So just as I've explained this afternoon regarding the central bank, the reasons why we're seeing the dollar strengthen and the US indices markets weaken. We understand why that's happening. It's due to bond yields. They're pushing higher, so the equity markets are getting a bit nervous, and capital's coming out of your riskier assets and it's going into the US dollar. We can see the flow of capital, so we can either position ourselves for those trades, or we can, which is what we're doing right now, is we're going to wait for the turnaround trade to actually get in on these trades to the upside. So there's a knowledge and understanding deficit from the vast majority of traders. They don't want to give themselves the time to learn this environment because there's quite a lot to it. And like I said, what I've just spoken about for the last 10 minutes, we've got 50 hours of content for our traders to slowly go through and digest and understand and be informed when you're trading markets. So those that know the least, unfortunately, end up losing the most, and that's the reality of it. There's no other way around it when you're starting out. So like you've said, you're starting out, where do you get the information from? What are your options? There's very few. There's a lot of educators out there that will charge you a fortune, and you may or may not benefit from it. It's a toss of a coin. If you go to our website, thelivetraderoom.com, we can give you, I suppose, a grounding in trading financial markets for $29 a month. So what that you could invest on, for a 12-month period, I think it's something like $15 a month if you want 12 months access, and that gives you access to over 50 hours of education, and we've got 4 different courses which go into a lot of this detail over time, and it's on demand, so you can access the information whenever you need it. Some brilliant content on there, and that's just the starting point. The real The important thing to do is to be able to apply what you've learned on a day-to-day basis. And for that, we have daily live trade rooms. So the idea is we'll try to inform you as best we can about where the opportunities lie. What market should we be looking at? Where would we be looking to enter from a probability perspective? How do we manage risk on the trade? How do we manage the trade once we're in it? And we got to be mindful of the psychology, how you can feel. If you go on a 10 trade winning spree, you might then feel that you're invincible. And what that does to traders, they start oversizing, they start thinking, right, well, if I can make this much money that quickly, I'm going to go all in on this trade. All of a sudden, all the rules and everything have just gone out the window, and they've got excited, and they've got, they've kind of gone too far over on that side. So it is a kind of, we've got no other alternative to take it step by step and to sort of learn this industry and give yourself a bit of time. And it really depends on whether you've got the time to learn it or not. If you do, we've got sort of a part-time option as well. We've got our Capital Growth Live Trade Room, which is only 15-20 minutes a day, where we actively trade during that session. So that's a really good starting point. It gives you a foothold in these markets, and we have our trade plan webinar every evening, all really designed to inform you on a daily basis and provide that sort of daily mentorship that traders really need, just to fill in the gaps, just to have someone to ask questions to or to talk to about trading. We offer sort of trading analysis as well. So there's a wealth of, I suppose, quite useful content over on our website. But I suppose we often get asked, how much money can we make? And sometimes we have traders that come to us with, £200 and they want to make $5,000. Well, the percentage return, that is, what's that, 5,000%, is it? Something like that, is not possible. It's not possible for any trader to yield that. And I am conscious of Bitcoin, I'm conscious of GameStop, I'm conscious of AMC, I'm conscious of all these short selling, sort of this new trading dynamic that's kind of kicked in over the last few months. So I'm conscious of those markets. Trading them is very, very difficult because they're exploding higher and they're reversing and they're up and down, and people are getting burnt left, right, and center. What you may hear about is the few successful people that have sort of taken the trades and benefited. The vast majority of people are getting chopped up and down, burning accounts. One of the biggest brokerages out there, IG, reported revenues up over 700% over the last 12 months. Now, they're already the biggest out there, and they've just sort of times it by 7. And it's because people are jumping in, opening up accounts, putting loads of money in and burning it, and probably doing it on multiple occasions. Just purely because, again, they don't know what they're doing, and that's a real problem. So you're probably right. If you've spoken to people that have burnt their capital, it's because they don't know what they're doing, and it's because they've got no regard for risk management and any of the important tools that every profitable trader has and develops, which is effective risk management. And they probably don't have that in any way, shape, or meaningful shape whatsoever. So if you speak to those people, of course, absolutely do not trade. If you want to go down that road, then we wouldn't recommend you trading anyway. If it's something that it's a skill you want to learn, like playing golf or whatever sport you could imagine, you have to put in a bit of time and effort. And I suppose the benefits of sort of trading is that it can become quite lucrative, but over time, not over, you need to put in a year or two of sort of study and understanding first, and then hopefully your career can kick off. But your return should always be a certain percentage of your deposit. But the idea is you grow the deposit over time. So that's what takes the time. So let's say you started with 5 grand in year one, and you were able to grow 30, 40, 50%. And let's say you push that up to 7.5 grand, which would be fantastic performance in year one. Really, really good performance in year one. And you add, another 50% on to building, growing that capital. If you do that for 2-3 years, you very well may get access to more capital to be able to start building and growing. And if you're some of the things for us is we look for a percentage return, so we risk a certain percentage in exchange for a percentage return. And over the course of 12 months, we adopt a positive risk reward. So what that means is we can cut those losers short, but look to let those winners run. And that's just a philosophy. That's just something that we've learnt. We've learned how to do that over time. And we do spend an awful lot of time talking to our traders about being able to do that. Once you get into a winning trade, it's very easy to get excited and to push the button and say, right, well, I want to book in profit. When in actual fact, all you're doing is limiting your gains, unless you've got a reason to do so. If you've got a reason to do so, that's fine. So it's all of these things, need to come together when you trade financial markets. And it's just depending on who you get access to the information from. And, we can certainly help you at a very, very low cost, just a monthly fee. Like I said, we've got a package on our website for as little as $15 a month. So I don't know what that is in pounds, like 10, 11 pounds. So we can certainly help you with that if that's the path you want to take. And it will just give you that level of experience for potentially the next 12 months. So look, we can help you with that. If you do want to find out more, you can speak to us through our chat function as well. Just go to the livetraderoom.com for more information on that. But some great questions. Thank you for that. So look, what we're doing and what we're currently looking at on screen is just the US indices. They're still very negative. They've not moved a huge amount, as you can see. We've been in this sideways pattern now for an hour and a half. It's threatening to push lower. We can just take note of this low down here. Just see if that's the case. We do want to just make sure we want to make sure we know what direction we're looking to trade these markets. And just right now, which happens occasionally, the market's moving completely the opposite direction in terms of the trade we're looking for. And that's what we're experiencing currently. Looking at some of the crude oil trade is taking a little bit of a trade to the downside. So that's one worth looking at. This is very close now to a structural failure to the downside. So it's looking at 63.12. We're just at that 63.32. So a break of this low. There's your structural failure trade, which for oil would be worth perhaps getting into. So from here, we would expect further downside. So we come back to crude oil. I do apologize, guys. We'll have to wrap it up there shortly. Gold, we spoke an awful lot about this market coming back up to the 1760. It's just rolling over prior to that, not too far, just a few dollars off a sell trade. And we're still technically above the monthly high. So in the not too distant future, we might get a decent sell trade probably tomorrow if we get some continuation. So let's see how this market reacts today, because we can expect a significant, probably quite a tough trading day today. The yen is beginning to find a little bit of strength. The euro pound just rolling over to the downside, having made a new low, and we are looking for this market below the 85.43 level. New Zealand dollar is really taking a move lower, and it's kind of quite messy from a price action perspective. It's quite messy. It's a two rejections to make new highs, but largely, you know, for the last 6 or 7 days, we're just drifting sideways, and now we've pulled back inside those levels, as you can see. New Zealand, so the Aussie, again, strong rejection at a high, running back into strong levels of potential support. The dollar, so really it's the dollar strength trade, and it is the equity markets weakness. And you see, with all of these trades, tomorrow would give us a little bit more to work with. Today is the attempts to make new highs and the fail and the rollover, and all we're running in to is retracing yesterday's price action. And from a probability perspective, these are generally not high probability trades, and you can see we're reversing yesterday's moves pretty much across the board. The interesting question comes, what next? You know, do we get a breakout in the dollar against the yen above the 109.37? The Swiss franc, you know, do we get further momentum to the upside? So what we'd recommend is, if you can be patient today, we will hope to get the correct correlation that we're looking for between the equity markets and the US dollar. At the moment, they're kind of moving in the opposite direction to which we would like to trade them. So for example, tomorrow, if we were able to bounce up to the 124.97 and we saw some turnaround price action and the dollar started to weaken and the equity market started to push higher, then we get some no-brainer trades off. So just for today, they're kind of moving in the opposite direction that we would like them to, and that's a bit of a pain. But that's why one of the pillars in which we teach traders is patience. Unfortunately, there's no getting away from it. And sometimes these moves stack up really quickly, and other times, you know, we have to be a little bit more patient for them. So just strong retracement of yesterday's moves. These are generally not high probability trades. And I say that because I would say that traditionally, but you know, there's an argument in the last 6 months they've become slightly stronger probability trades just because of the nature of price action, really. But it's the breakout of these levels to the upside or to the downside that we're really quite interested in. So I do apologize. We've got another session in just a little while, so I'm going to have to let you go. Thank you as always for joining us. Thanks for your questions there, Saklan. I do hope I answered them for you. And we'll be back. Actually, we don't have this session tomorrow on Fridays just yet. We will have them back pretty soon. So it's just Mondays to Thursdays at 12 noon. So feel free to join us. Obviously, completely free of charge, just through our YouTube channel. Try and give us a thumbs up if you can, and subscribe to our channel. We'll have a large amount of content coming online now pretty shortly. So you can be notified along those lines, and yeah, you'd be very welcome to join us. So on that note, guys, thank you very much for joining us, and we look forward to seeing you next time. For everyone here, bye for now.